Right now, we're building a little over $200 million in multifamily real estate, and everybody's asking me, how are tariffs impacting you? So there's a couple things to consider. When the interest rates went up a couple of years ago from, let's say, 4 or 5 to now over 9 for new construction, people pulled back. So that's a supply shock negatively. In other words, people said, we're going to wait and see where interest rates go, so that they're deciding not to build. So the normal supply of real estate is significantly down as a result of higher interest rates. That's the really important piece to understand, because what happens when there's a lot of construction? Subcontractors, they have their way with their pricing, and everybody's clamoring for like a plumber or electrical guy or whoever it is. You know, these companies, they are in control. They can decide if they want to do a job. They can price it the way they want. So there's a lot of competition, so prices are up. So what happened when real estate construction went down, then now all of a sudden there's not a lot of subcontractors with the same amount of work. And so now they're finally calling us back. And so as a developer and somebody who's building, we now are finally in a position again to be able to negotiate with somebody that doesn't have a lot of work. And so the pricing came down as a result of that. And so you can't forget about that. And the reason I bring that up first is because now everybody layers on this new tariff thing. So we've already seen declining pricing because there's way less construction and way less opportunity for, let's say, a plumbing company or an electrical company to be able to price that really high. Just like any kind of a business, when there's a lot of business, you can command the pricing. And when there's not a lot of business, you have to be a little more frugal. So now let's layer on this tariff thing. So right now, we're not personally seeing a big factor when it comes to tariffs. And here's why. Because again, when there's a big pullback on construction, we're now building with existing inventory that was already in place. Now, that could change and it might change. Once that inventory, once the stuff that was already here, now don't forget about the lag, because the stuff that was already here is what we're using to build. So at least in 2025 and 2026, we haven't seen any real significant tariff increases as a result of our new construction. Because of, obviously, we're getting better pricing from the subcontractors. Now, I'm not saying that there isn't and there aren't things that haven't slipped through, because that's definitely true. It's not really adding a lot to the cost to build anything at the moment today. That could definitely change as we start to see in the second half of the year, and it will probably show up in 2027. That's precisely why we're trying to buy now, because the properties that we're building now, we're being able to build affordably, not based on yesterday's prices, but based on today's prices, and also in between what will eventually be more demand for apartments. So we're trying to catch this window. And by 2027, when we're opening and we're renting, then we could see that again. And that will just help create inflation and demand on whatever we're building today in 2027 and 2028. It'll make whatever we're building today seem like a great deal in a couple of years from now. So why I think now is a good time to buy is, one, interest rates are up and inflation is up and people are really feeling the squeeze. So what does all that mean? What that means is that single family prices are pretty high right now and interest rates are pretty high right now. So that means if somebody wants to buy a home, many times it's out of reach for them because the price of the mortgage plus all the other costs for taxes and insurance and all the capital work that they might need on top of the mortgage is going crazy right now. So the cost to own a home today is wildly expensive if you look at historical numbers. At the same time, rents are actually staying flat. So on the multifamily side, when rents are staying flat and there's a lot of people competing for renters, which is happening right now, don't forget, why would that be happening right now? It's because of properties that got started in 22, 23, when interest rates were lower, are hitting the market today, creating a lot of choices for the consumer. So the consumer has lots of choices and rents are flat. On the single family side, they don't have lots of choices because single family home prices are high. And so right now we have this little window where there's a lot of competition for the renter And the occupancies and everybody and the landlord and the developers are fighting for the occupancies. And we have rising costs just like anyone else. So if you own a multifamily property, for example, your insurance is higher, your property taxes are higher, your utilities are higher, your labor costs are higher, and those kinds of things. So we're getting our operating expenses are higher. And of course, we're fighting for the revenue for the occupancy with concessions and things like that. So what that does is it creates a little bit of a window for if you're buying these, because what you want, it's counterintuitive to what you would think. What you want when you're buying a multifamily property is disruption.
The old economy is dead. The game changed and most people haven't even noticed. In 2020, you could get rich off of cheap debt, 2% inflation, and blind optimism. You didn't need to be smart, and most people buying real estate during that time weren't. But now, inflation is still eating your savings. Interest rates are stuck at levels that we haven't seen for 20 years. And the hope and hold strategy that most investors use, it's a recipe for getting wiped out. Here's the truth. The new economy rewards speed, leverage, and adaptability. And the people who are winning now, they've already made the shift. They've stopped waiting for the Fed to fix it. And they're playing offense. They're using inflation, they're using debt, and positioning for the next real wealth wave. I just bought a property that in 2022 was valued over $140 million for $92 million. I'm breaking all this down in my free masterclass. If you want to learn how to survive and thrive in this new economy.
You want high vacancy. You want lots of concessions. You want high operating costs. You want high interest rates. Because what does that do to the person that owns them today? It's disruptive. And so as somebody who's been doing this for over 30 years, I'm looking for those cracks. I'm looking, how do I solve the issue? And can I even solve it and buy somebody else's problem and fix it for the long term? So we've been focusing on a couple things. One, we've been buying properties at below replacement cost. Brand new projects that are under construction today with high construction debt, and they're struggling to get the tenants. That's precisely what we're looking at. And those deals are everywhere. Because what you guys are seeing, you're saying, well, I see all kinds of stuff under construction. That's true in many cases because those projects were started 2 and 3 years ago. Don't forget, it can be 2 to 4 years for a multifamily project to be built. And then you got to fill it with hundreds of tenants. So there's a process. And so we're trying to come in at the end and be able to buy these properties that are not quite yet stabilized and have construction debt and take somebody else's problem and fix it, put new debt on it and stabilize the property through our property management company and hold that asset for our own investors long-term. And we eliminate all that construction risk, all that construction interest risk and all that. The second thing is we're trying to find properties that have floating rate debt. So in other words, people that decided to get floating rate debt in the last 2 or 3 years and the debt costs have gone up. And even though the properties might be highly occupied, and they might be running okay, those properties have definitely adjusted in price significantly, 30, 40% off of what they were just 2 or 3 years ago. So we can come in and buy those properties today for the cost of the debt or even lower. So we're now looking at properties, existing properties. We're trying to buy them for the cost of debt or lower and put fixed rate debt on them once again. And the third thing is we're breaking ground on a bunch of construction where we already own the land and we're getting our construction pricing at yesterday's prices because they've all come down because there's certainly less people building right now. And we're able to negotiate with our subcontractors a little bit easier. Just last week, my partner Ross had one project fully built out and he emailed every subcontractor and said, you can have the job if you lower your cost by 5%. And everyone did it. We're in a position now where we can negotiate down these prices to be able to build things for cheaper. And we weren't in that position just a few years ago when interest rates were low and everybody was building. So those are the 3 strategies we have going right now.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
But all of this leads to 2027 and 2028. The new construction will be done and will be leasing up at the right time. Will there be scarcity in the market from a renter standpoint? In other words, the renter's choices will go away because the single family home prices are putting people into the rental chair, and they don't want to be there. A lot of people want to buy, but they can't right now. So that's the one thing that we're banking on. And of course, we have no idea where interest rates are going to go. So the existing properties that we're buying today, we're buying at fixed rate debt. So we always know what our debt costs are going to be moving forward. So if you're an accredited investor and you want to get on our list and just take a look at the business plans that we have coming, no obligation, just take a look at them. If you're accredited, just click the link below and you'll be on the list, and you'll be able to see exactly what I was just talking about in the form of a business plan.